If we say that the destination is to be happy, what kind of role does money play in that?
I don't need to drive a Ferrari. I don't need to have the fanciest house. And in a way, you think about Buffett and Munger, and they've done the same thing, right?
Welcome to the Investors Podcast. I'm your host, Stig Brodersen, and I'm joined by my co-host, William Green today. William, how are you?
I'm very well. I'm delighted to see you. I sound a bit raspy because it's earlier in America, and I'm just on my third cup of coffee, so I'm still waking up.
You're still waking up. This sounds good.
Exactly. Right.
All right. So as I was saying there in the introduction, so William and I will be hosting a new quarterly series, and we're calling it Richer, Wiser, Happier, which is a tribute to William's book, but it's also just because it's just a fantastic title, you know. So the idea is that we are going to talk about every quarter. Well, let's see how the first one goes, but every quarter we're going to talk about what have we experienced over the past quarter that had made us either richer, wiser, or happier. So that's sort of like the premise of this format that might be a bit more informal than what you as a listener are usually tuning into. We will be playing different audio clips with guests from William's wonderful podcast, Richer, Wiser, Happier, that you can also find in this feed. For example, later in this episode, we'll play a clip from William's episode with Ray Dalio. But we won't constrain ourselves only to play an audio clip for our own podcast. We're also going to play a clip, for example, from Charlie Munger and the Q&A he did with the at the Daily Journal meeting here we had recently. So we have 5 segments. The first one, values or money. We're gonna go right into that here in 30 seconds or whatnot. Then we have one called Money and Happiness. We have one called What We Learned from Ray Dalio, another segment then What We Learned from Charlie Munger, and then at the very end of this episode, we're going to talk about our top 5 books from this recent quarter, Q1 2023. So let's just go right into the first part. That won't be an audio clip, but something that I pondered on for quite some time. I spoke with Guy Spear here on We Study Billionaires 414, and he talks about investing in companies or not investing in companies that destroy value for society. I guess I don't have to say it's evident that Guy is a fantastic, wonderful person, terrific investor. So I also think you get the both of both worlds investing with him. But I also kind of feel it raises the question, what if you had to choose? And so we're trying to like zoom out a bit, go up in the helicopter and talk about some of the more ethical things. And William, if I can give you an unreasonable premise here for my question. So I think you've told in another episode that you invest with high quality people such as Guy Spear and Matthew McLennan. So let's say that I could guarantee, for whatever reason, if you invested with Guy, you would get 9%, completely stable. I know I'm gonna make it sound like a Bernie Madoff kind of thing. I want to say it was around 9%, but it's not a Bernie Madoff thing. You could get 9% no matter what. Great person, terrific investor, wonderful human being. But you can also invest with another fund manager, guaranteed 11%. But you knew that asset manager had bad values. Who would you invest with, and how do you think about this values or money dilemma?
I'm deeply idiosyncratic, so I'm not saying anyone else should do what I do. But I sort of surprise myself with my answer, which is I wouldn't hesitate to take the lower return to invest with the person I trust and like, and to avoid the person that I think is kind of shady or unpleasant or selfish or just out for themselves. That's a pretty idiosyncratic answer, but I think you have to really think hard about who's in your ecosystem. I remember, look, I'm totally biased on this front as well, because Guy is a very old friend. He's someone not only who I've invested with for over 20 years, but he's one of my closest friends. I just spent a week with him in Switzerland. So I'm totally biased here. But I feel like I want to have people in my ecosystem that I like and that I trust and who I feel have their interests aligned with me. And so when I look at someone like Guy, when I first invested with Guy many years ago, probably 21, 22 years ago, one of the reasons why I invested was not just because I thought he was very smart, which he clearly is. It was partly because, if I remember correctly, he had just got an incentive fee for having really good returns in some period. And then immediately the fund had gone down. And much to his lawyer's annoyance, he returned the incentive fee because he said, "Well, I didn't really earn it. I like it's unfair for me to take it." And I thought, that's such an eccentric thing to do. And so I want to be partnering with someone who's willing to go against their own interests. And then at the same time, he also had basically half of the money in the fund was his family's money, his father, his sister, uncles, aunts, lots of family members, and then friends and partners of his father's. And I just thought, okay, so there's an alignment here where if he messes up, he's going to suffer more than I do. And I think those two instincts were actually correct, to align with people who are prepared to go against their own interests in your favor, and who are eating their own cooking. This is something that Nassim Taleb talks about, right? You want to have skin in the game. You want a money manager who is going to get hurt alongside you or benefit alongside you. And so, if there's some kind of takeaway for our listeners, I think it's really to think hard about whether the person you're investing with has your back, or whether they're just out for themselves. And I think one of the easiest ways to tell is just by looking at the fee structure. So I look at, say, Guy's fee structure and the share class that I'm in. There's no annual management fee, and so he gets a percentage of the profits if he gets good performance. But if he doesn't perform, he doesn't get paid anything. And Monish Pabrai, who I think you invested with at one point, has a very similar structure, and it's cloned from Buffett's structure in the 1950s partnerships that he had, and actually Buffett cloned it from Ben Graham. And it's something that most people can't afford to do, right? Most hedge fund managers are just they'd rather have a structure where they get 2% of the profits, 2% of the assets in a management fee, regardless of whether they do lousily or not, and then 20% of the profits. And so, as Monish would say, it's heads I win, tails you lose. And I want to be partnering with people who are looking out for me, and for the same reason I invest in Berkshire Hathaway, not because I think it's going to have the greatest returns on earth, but there's no fee. You're not paying them expenses. Munger and Buffett are making $100,000 a year to run this enormous business, and you're getting the benefits of the float and all of their expertise and brilliance and the competent, honorable people they've got working for them. And so I don't really know how Guy's going to do. I don't really know how Berkshire's going to do. But at least I feel like they've stacked it in my favor, that they're treating me as a partner and they're trying to make money with me, not off me. And so that's critical. But then you have to kind of also hedge against your own blindness. So what if I'm wrong in my assessment of those people? And so even though I'm trusting certain people to behave in an honorable way, I'm still diversifying in case I'm wrong. So I remember John Templeton telling me many years ago that for regular investors, you should probably own 5 or 6 funds that give you exposure to different parts of the market. And so anytime I get carried away and I fall in love with some investor or some fund or some stock, and I think I should pile into this, I just remind myself, well, I've been wrong before. Why should I assume, as Templeton would say, why should I have the arrogance of believing that I found the one fund, the one money manager, the one asset class? And so yeah, I want to invest with people who I think are honorable and decent and have aligned interests with my interests. But I still want to diversify in case I'm wrong.
I think that's super super smart. Um, And William, just to one thing about like investing with the right people. What you said before about this ethics, it really makes me think of the episode you did with Fred Martin not too long ago, when he talked about how management, at least for him, was about foregoing money to help clients get better returns, because if a fund is big enough, you can't get the same returns if you can whenever it's smaller. And think about that, asset managers are generally, they're incentivized to manage as much money as they possibly can, because whether it's a 2 or 20 model, whatever it is, generally you make more money if you manage more money, even though it's not to the benefit of your investors.
Yeah. Yeah. And I think there are clues in someone's past behavior. I was discussing this with Tom Gaynor on an episode that'll come out shortly, where I was saying, how can you tell whether the person you're dealing with has integrity? And he said, well, look, there are clues in their past behavior. And so you look at Fred Martin, and many years ago, he closed his small cap strategy to new investors when it had something like $400 million in assets. And so in the 15 or 18 or whatever years since then, he could have made tens of millions of dollars in fees that he was willing to forego because he wanted to keep it small, because he said it was really impossible to manage a huge fund that invested in small cap stocks. So there's someone who actually has demonstrated in his past behavior that he cares really a great deal about his investors. So look for the clues, look for the past behavior. Look for the fee structure. You don't just want to believe someone because they say the right things. I think there's usually, it sounds like an odd analogy, but it's like when you see someone who's committed a crime, you tend to see that they had the same modus operandi multiple times. And so I think when you see people behaving poorly, they behaved poorly multiple times. And when you see people behaving well, I've seen it with Guy multiple times, where that same instinct that he had with returning the incentive fee early on, he did something recently where he and you have to accept the fact that I'm totally biased on this because he's a good friend. So I'm not trying to say this is a shill for Guy, but they did something recently where they figured out that basically, because the fund had a bad year last year, they could actually offer existing investors or new investors the opportunity to invest at a previous high watermark, which I'm not explaining well, but it basically meant that you got the benefits of the fact that it had done poorly, so that you'd be investing with lower expenses, lower fees going forward. And so they basically figured out a way to take money out of Guy's pocket and give it to the investors. And I remember once a Guy was talking to the Mark Chapman, I think it was, who works, who sort of, I guess is like the CFO at Aquamarine, Guy's company, and it said they were talking about the new fee structure where you could be in a 5-year share class where you would get no Guy would get no money at all if he didn't perform well. And Mark was like, "Are you sure you want to do this? Like, you might make no money for the next 5 years." And Guy was like, "Yeah, welcome to the world of aligned interests." And I think that's really interesting when someone's prepared to do that. It's that just makes me feel good. I don't know how good his performance will be, but there's a record of behaving in an honorable way that I like.
Yeah, I like that, and very few people just does that. They promise a lot, but they're not ready to take the pain together with you. And it's I just see that everywhere. And one quick example, before we got our own sales team here on the podcast network, we got constantly asked whether or not someone could do it for us, and they guaranteed, like, we could say, I don't know, do $1 million. I was like, that's great, but do we have a guarantee that if you don't, you supplement up to $1 million? And they're like, no, we can't do that. But you use the word guaranteed, so what does that mean? That means we're gonna do our absolute best. Okay, So you take the upside with us. That's great, but you also take the downside because we could also do X, Y, Z. Like, no, 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 no. We only want to take. They didn't use the word. We only going to take the upside with you. But that is how most people are wired, and that's the way it is, and that's also why it's so wonderful whenever you meet with people like Guy or Manish or Matthew McLennan, and I think at least for me there's something like I come from a very normal, if I can use that word, because it's always dangerous to use words like normal, but a typical Danish middle class background, and I wouldn't say that I was taught that people in the financial industry was bad people, not like that, but they were definitely not good people. And I think there is a part of me who are like really, really happy to. And don't get me wrong, I definitely met bad people. I've started in the financial industry. I've seen bad people there. Don't get me wrong, but you also meet wonderful people, just like you do in all walks of life. Um,
Well, also, Stig, remember that thing that Buffett said to Monish and Guy at their charity lunch back in, I think, 2008 it was, where they paid $650,100 to have a charity lunch with Buffett. And Buffett said to them during that lunch, I don't want to be in debt because I don't want to see what I'm capable of doing. And Guy has said to me, look, if even Warren is vulnerable under certain circumstances where he thinks he could behave poorly if he were under pressure financially. What about the rest of us? The rest of us are that much more vulnerable. And so I think it's not just a matter of partnering with honest and honorable people. It's also that even decent people can do terrible stuff when they're in vulnerable situations. And I see that with myself, where when I'm stressed out, I'm much more unpleasant than when I'm unstressed. And so I think you want to structure your life in ways that are more likely to tilt the odds of your behaving decently. And so that means living within your means, not having an excess of debt, so you'll panic, not having such an expensive lifestyle that you need to take advantage of other people. So it's a guy once said to me, look, you have to move the candy away from you. And which is metaphorical, because in both of our cases, we've not been very good at moving the chocolate and the cappuccinos away from us. But I think it's true. You want to structure your life so that there's not as much temptation to behave poorly. And so if you're investing with somebody who, when I went to stay with Guy recently in Switzerland, he lives very nicely, but it was really interesting. We drove back from Klosters in the mountains to his home in Zurich, and we were in his old Porsche, which is the same Porsche he picked me up in from the airport all those years ago when we were working on his book, The Educational Value Investor. And it's now 16, 17 years old. And so still a really nice car, but it's not kind of glamorous to drive a 16 or 17-year-old car. And so I think he's structured his life so he's not put himself in a situation of jeopardy where he needs to behave in an unethical way. And that's important for me. I need to think about how to structure my finances so that I'm not going to panic, but also how to structure other aspects of my ecosystem so that I'm likely to behave well. And so this gets at who you invest with, who you hang out with, who your friends are, even what you're reading. Think of Munger talking about hanging out with the eminent dead by reading certain things. And so you want to structure your entire ecosystem so that you're less likely to succumb to the less noble side of your character, I think.
and can I perhaps one very small example of that? Now we just talked about the imminent death, so that's a that's a tough act to follow, William. But I think a lot about how to design my life in a way to optimize for happiness. I'm sort of like going straight to the source whenever I say optimize for happiness. I remember that Preston and I read a book. I don't know, it was probably 5-7 years ago. It was called Delivering Happiness, by a gentleman called Tony Hsieh, who's unfortunately not with us anymore. And he said that if you continue asking a person why, like if they do XYZ, like continue to ask why, the fifth time or before, they're gonna say, because it makes me happy, or they think it makes them happy. And you could then argue that, it's not making them happy. But that's not so much the point. The point is that they're doing it because they think it makes them happy. Even people doing terrible things. I thought a lot about that, and I've tried going back to the original topic about how to optimize for happiness and how does that relate to investing. And so I remember we had John Huber on the show a long time ago, and he was talking about Facebook, which is called Meta today, and he talked about why it was such a great investment, and why you could expect XYZ in return. And he was completely right, by the way. But I remember thinking about it, and I'm like, I understand the business. I used to use the product. I can see the business case. It was very easy to analyze, but I did not want to invest in it because every time, like, Meta makes me sad. Like, I know it probably comes across, and I have a good friend who works there, and they're probably wonderful people working at Meta, and they're making a lot of people happy. Don't get me wrong, but like for different reasons, the company Meta makes me sad, and I also think that they, to some extent, do some not so good things for society. I could be completely wrong or right about that. That's not so much the point. But I remember thinking I could be making money on Meta. Of course, you could also argue I could be wrong, but I could make money. I just don't want to make that bet because that means I have to read their annual reports. Every time I hear something about it in the news, I have to think about the company. I just don't want that life, even if it came with a profit, because I optimize for happiness. I know it probably comes across as naive, but it's one of the things I'm thinking a lot about, which sort of like goes back to this unreasonable thing I said to you before about William. Like, okay, so you can invest with a wonderful person with a low return, and how do you think about that? So it was just a different way of going into that topic.
No, I think it's a really important insight. And look, we're not being totally naive here, because it's not like we would invest in a lousy company or with a lousy fund manager who we thought was lazy and incompetent just because we thought they were a nice guy, or that the company was a really ethical company that treated its employees fabulously. You want to invest with talented, capable, driven people and in good businesses. But I think you're not just optimizing for profits. I mean, that's not the most important thing for me. I when I think about my financial goals, I want to be financially independent and free and able to do whatever I want to do. I don't need to drive a Ferrari. I don't need to have the fanciest house. That's not interesting to me. And so it's not uninteresting, but actually, no, I mean, without wanting to sound judgmental, I would be slightly embarrassed to drive a Ferrari. And that's not a judgment on the people who do. I just think it would be it wouldn't suit my personality. So for me, when I think of my goals and my financial ambitions, which are sort of basically to live the way I want to live without being answerable to anybody, to be in charge of my own schedule, my own time, where I go on vacation, whether I stay in a really nice hotel. I'm a sucker for really nice hotels, so it's not like I've taken a vow of poverty. I'm a sucker for really good food and stuff like that, and expensive clothes, like they're not flashy, but they're really well made. So it's not like I'm some kind of monk. But to get that sort of lifestyle, if I were to make 10% a year, that would be amazing. I'd double every 7 years. And I don't know, is that before tax? Is it after tax? I don't know. Does it mean I actually have to supplement it by continuing to add to the pot myself by saving more? Maybe there are years where you make minus 10%, but you add 20%, so you just keep beefing up what you're investing. But if I act in that way, investing in a sustainable way, trying to get a decent return, I'll be fine. So I actually don't need to make huge compromises where I take wild risk or invest with someone who's kind of scummy but will probably do really well. So I think part of it actually, Stig, just requires you to know what the destination is that you're heading for, that you're aiming for, and then you work backwards from there, which is something I write about when I write about Nick's Sleep in my book. This idea of starting with a desirable destination and then working backwards to figure out, well, what are the inputs that'll get you there? And the inputs that'll get us to being financially independent and secure, I think are saving, living within our means, investing responsibly, diversifying so that we don't blow ourselves up, not trusting one person or one country or one bank or one brokerage firm or something to an absurd degree so that then if you're wrong, you get blown up. So I think start with the destination and then work backwards to figure out the inputs that are likely to get you there.
So if we say that the destination is to be happy, I sort of like want to have a discussion about what kind of role does money play in that. And it's just I've always been fascinated by that question. I remember again, like growing up, I hope you don't bill me for like a shrink kind of session after William, but I remember having this a background where I was taught that it wasn't because anything in my family had anything against rich people, but it was definitely like it's not like rich people are like happier; they just have different problems. I remember there was one thing we talked about, but at the same time, I also was in a community where it seemed like everyone wanted to have more money, and I remember as a kid, I was like, that makes no sense. We just we just talked about how money doesn't make you happy, and then everyone still wants more money. Like as a kid growing up, you're like, that doesn't make any sense. And so whenever I read like articles or see something in the media, and I kind of feel sometimes whenever there's a billionaire who have problems, there's almost like an element of gloating in a way where it's not fair that this person is a billionaire and has a great life. It's almost like we need to be some kind of should be some kind of universal karma or something around that. And so, I know that you have spent a lot of time with billionaires and high net worth individuals, and you can say that we've done that here on the show also. But I know you really know many of those people well. You've flown around in their private jets and like really gotten to know them. Can I ask, what kind of role does money play in the happiness of the richest people? Without naming any names, not necessarily like, could you make some general observations about that, William?
Yeah. I'll give you a couple of very specific examples of people I've talked to about this sort of thing, or people I've observed. So I got to spend a bunch of time with Bill Miller the other day, and I've spent a lot of time with Bill over the years. And Bill, as most of our listeners will know, is one of the great investors of our time. He had this incredible, unprecedented streak of beating the market for 15 years running. Then had a terrible period during 2008, 2009, and then has had this unbelievable recovery rebound where his fund was like in the top 1% of all funds over the next decade or 12 years or something like that. And he just retired at the end of the year, and is now at the end of 2022, and is now handing over the reins to his son, Bill the Fourth, and to Samantha McElmore, who I'll have on the podcast very, very shortly. And so I've interviewed Bill many times over the last 22 years, for the best part of 100 hours, I think. And so I've really seen him in all of these periods, like during the glory days when he was like totally on top of the world during that 15-year streak, then during in the aftermath of the really difficult time when he got crushed during the global financial crisis, then during the rebound where he got kind of vindicated. And now again, I'm seeing him now that he's probably about 71, 72, something like that. And I was really struck when I saw him the other day, just how happy he was. And I think there are some observations about what I think makes him happy that might be kind of to some degree universal. So the first thing is, he just got remarried to a really lovely woman who I met, who's just great. So he's got great relationships, right? And he's worked with Samantha Macklemore for 20 years. He's worked with his son, Bill IV, for all these years. So he's worked with great people. He's got the same assistant, Darlene Orange, that he had when I first was writing about him, when I was writing a profile for Fortune of him back after 9/11. So he's got people he really likes around him who are really decent and who he trusts and who trust him. So that's really key. So the relationship part is really important. Then he has tremendous autonomy increasingly. So there was a period when he worked at Legg Mason where it was a public company and he had all of the accountability to the board and even writing shareholder letters. There would be like a big process, right? There were things you had to say or couldn't say or whatever, lots of oversight. And I think part of what I've seen with Bill over the years is he's become more and more autonomous. There's this sense in which it's Bill unbound. And now, even more so, now he's not responsible for managing anyone else's money. And he basically, he's the biggest investor in the funds that his company manages, and he still has an ownership stake in the company. But he's basically responsible now for his own portfolio, which basically consists, for the most part, of 3 investments. And so he's able to concentrate massively in a way that he couldn't for regular shareholders. I mean, he's got an enormous stake in Amazon that he's owned for more than 20 years, an enormous stake in Bitcoin. And so most people would be like, that's crazy to have all of your money, to have, 70, 80, 90% at times of your money in 2 assets that are fairly risky. But his cost basis for both is tiny, right? Like $200 a coin he started buying Bitcoin at, and bought much of his stake at $500 around there. And Amazon, basically his cost basis now that after the split is something under $1 a share. So he's made so much money off them, and he's owned them for long enough that it's his cost basis is almost zero. But so he's investing in a way that's totally true to himself, total autonomy. And I think there's a real clue there to what actually makes for happiness. It's living in a way that suits you with all of your idiosyncrasies. And so there was I think I've told you this story before. There was a time when I was interviewing Bill at his home in Maryland a few years ago when I was working on my book, Richer, Wiser, Happier. And I spent about a day and a half or 2 days with him in Maryland, where he has a home. And he would come in wearing the same black T-shirt or the same type of black T-shirt and jeans every day, and he had kind of a hole in his cashmere socks. And he's like, he's dressed the way he wants. He's in charge of his time. And he said somebody had asked him to be the keynote speaker at a gala event, and he said, "Well, what's the dress code?" And they said, "Well, it's black tie. You'd have to wear a tuxedo." And he's like, "No, I threw out my tuxedo, and I'm never buying another one." And so he's structured his life in a way that he's got rid of a lot of the stuff that he doesn't like to do. And so I was talking to his wife the other day, and she was like, "Well, it's amazing now he can really just read and do the things that read and invest and take advantage of the fact that he's got this really brilliant brain." And it's just great. It is like Miller Unbound.
If you enjoy this podcast, you are going to love our free investing newsletter called We Study Markets. We've realized that not everyone has time to listen to a podcast every day or even every week. So we took this same type of content and put it into an easy-to-read newsletter. In just 5 minutes a day, you can stay up to date with what's going on in the financial world and what's happening with your money. And it's completely free. Join over 30,000 other readers now by simply clicking the link here on the pop-up on your screen and then entering your email. It's that simple. Just click the link here in the pop-up on your screen, enter your email, and start knowing what's happening with your money.
So I think, when I look at things like that, that's clonable for me, right? It's not like I have the wealth of Bill Miller, even a fraction of it. But I can say I want to structure my life as much as I can in a way that's true to my own weirdness, my own idiosyncrasy, my own values, my own sense of what's enriching. And so for me to be able to spend my morning chatting with you as a friend, talking about interesting subjects to you and me, that's a real joy. That's a source of pleasure. I mean, as I was coming into my office here, I sort of started beaming, and I was like, "This is great." I get to chat with Stig. I get to be in this beautiful office space that I share with this friend of mine, Matt Ludmer, who's a really lovely guy, and I'm in charge of my own structure, and there's my own time. And there's no one really to tell me that I can't drink coffee as I'm on the podcast, even though it looks unprofessional. And I'm kind of wearing a semi-clean shirt or whatever. It's like I'm sort of in charge. And for me, as somebody who really values autonomy, who really values not being told what to do, that's incredibly valuable. I value that more than the money. And so I think Bill, similarly, when I look at Bill, he's structured his life in a way that suits him. And I see that again and again with the happiest investors that I've seen, that they're doing what they want, right? So he's doing intellectually enriching work, working with people he likes, totally independent, true to himself. And then also he's doing a lot of charitable stuff, right? So Bill has given, I think he gave $75 million to Johns Hopkins, to the philosophy department. So he's a philosopher himself. He came out of the PhD program at Johns Hopkins, couldn't complete his studies, and then because he couldn't really afford to, because he came from a very modest family. His father was a taxi driver, among other things, and so he didn't come from money. And studying philosophy has had a profound impact on his success. So he's given back to the philosophy department at Johns Hopkins. He's on the investment committee at Johns Hopkins, so he's helping his alma mater. He's learned an enormous amount from the Santa Fe Institute, where they study complexity science, and so that helped him to invest very early in things like AOL and Google and Dell and Amazon. So he's given them, I think, a gift of $50 million. And so it's not just that he's got a yacht and a private plane and stuff, which he does have, which is nice. And he's got a really nice house in Maryland and a really nice house in Florida. I haven't seen the house in Florida, but I know it's on an island. And I think I'm sure it's pretty luxurious. And he's got an amazing book collection. So he's got the toys and baubles, but he's also giving money away to things that have helped him and that he thinks are going to help others, right? The study of complexity science has all sorts of implications in terms of climate change, AI, things like that. So I think that's another really important component of happiness. There's got to be some element of sharing built in, some bigger purpose. It's not that the yacht and the plane are not enjoyable, right? Those are fun things to have for him, but he's sharing stuff. He's giving back. So I think I hope that gives a few clues as to the role of money in the lives of these people. It's not enough just to be rich. Yeah, they're very competitive. There is a sense in which the money is a kind of scorecard. It's a marker of success. But it's much more than that. I mean, Howard Marks once said to me that being a billionaire had made him less fearful. So there was a psychological benefit for him. But it's not, I don't know. I mean, Howard had, I know at one point he bought a home in New York for $52 million or something. So he lives very luxuriously. But really, I think, again, he's somebody who really loves ideas. In my book, I said his real drug is ideas, not money. And I think that's true. He's someone who loves to read, loves to think, and he gets great pleasure out of teaching people stuff, out of sharing ideas. So again, he's structured his life in such a way that he's I think he has probably about 1,000 people working at Oaktree, but they're not really reporting to him. So he's not got any management responsibility. He's really like the philosopher king at Oaktree, whose job is to think about things like risk and uncertainty and write about it in a way that's helpful to his clients and to regular people who read his memos. So again, structuring his life in a way that's true to him.
Which, if we have to boil it down to one thing, if I can just say, like, that autonomy is just so important, regardless of what fancies you. And it's easier to have that autonomy if you have money. So whenever we started the podcast, a long time ago, I want to say 2014. Wow. But anyways, whenever we did that, we started reading a lot of books, Preston and I together, and we still read a lot of books. We just don't talk so much about it on the podcast anymore. But there's one book in particular that really made an impact on how I saw this good life, for the lack of better words. And it's a book called Call Me Ted. It's not a good book, by the way, so that was not why it made a big impact on me. But it's about Ted Turner, and I don't know what he's most famous for today. Perhaps because he gave $1 billion to United Nations. I'm not completely sure
Well,
what.
he founded CNN, right?
He founded CNN. Yes,
CNN. That's a pretty good contribution to the wealth.
That's probably what he's. Yeah, so he founded CNN. Turner Broadcasting System. Merged with Time Warner, and then later at the biggest corporate merger, $160 billion at the time, with AOL, which was an interesting case in itself. But it was really that merger that was, to me, that was just really interesting, because he, for all intents and purposes, had all the money in the world. At least whenever you're looking from my vantage point, whether you have $100 billion Warren Buffett money, or you have $1 billion Call Me Ted money, it's the same. It's probably not the same if you have $1 billion, but at least to me, it's the same if you have 100 or one of them. And he talked about his personal struggles in that book, and how proud he was at CNN, how he invented a new type of reporting. It was actually because of the Iraq War, and how everything was covered, how they played a role in that war. But he was so proud at so many things, which it was wonderful. Don't get me wrong. And then he talked about this painful period of his life where he was doing the merger. He was like now a minority shareholder, minority in voting rights. He couldn't really do what he wanted to do. He had to have this famous press conference where he had to say things he didn't want to say. And you'll be thinking, like, this guy, he can do anything in the world. He's a billionaire. But he felt so constrained. To your point before about Bill Miller, like all the different tasks that you now have, being one of the guys in this public company, one of the faces of that, he felt he didn't have any autonomy. Like, it was clear that he had a big ego, and there was hurt, because now he was, like, I don't know, the second most important guy in this company with tens of thousands of, and the rest of us might be like, wow, you're the second most important. But to him, he was the first loser. There's one winner, and then he's the first loser. And so the reason why I want to bring up that book is I remember thinking a lot about it, and thinking, if I would ever to be so lucky, that TIP and everything that happened would be successful, I would never ever put myself in such a situation where you have everything in the world and you're just miserable because you don't have the right yardstick. You're just setting yourself up for failure. So it was just a story I wanted to share with you, William.
Yeah, I'll tell you a great phrase that I spent a lot of time with a multi-billionaire who I helped him write his memoir that hasn't been published yet, and I have no idea whether it will be. But he's a very, very interesting guy, and he said to me at one point, he talked about, he knows a lot of the richest people in the world, and knows how miserable many of them are. And he said to me, he used the phrase poor rich people and rich poor people. And I thought that was really revealing, that there are people who are incredibly rich externally, but actually are incredibly poor. And that's, it's difficult because there's some part of us, as you were saying before, people like to gloat about the problems of the rich. And I don't think this is about that. It's about understanding that if your life is empty in certain ways, for example, in terms of peace of mind or friendship and great family relationships, it's pretty barren. And this was one of the interesting things that I learned from interviewing someone like Ed Thorpe, right? Who as we've talked about Ed before on the show, right? This is a guy who's probably the greatest game player in the history of investing. He's a guy who beat the market at blackjack, beat the market at so many different games, right? Even at roulette, he
Yes,
managed to
I was
figure out
just
how to
about to
win.
say, even at roulette, and people might be thinking, how is that possible? Well, meet Ed Thorpe. He had to
Yeah,
use a
he's
bit of different techniques, but he would swear to this day it was not illegal at the time. It is now what he did, but what he technically did at the time wasn't illegal.
yeah,
But
he's
yeah,
a true genius
yes,
and
yeah,
an amazing game player. And so I said to him, look, if you were approaching life as a game, how do you stack the odds in your favor so you win? And one of the things he said to me is, well, look, who you spend your time with is probably the most important thing of all. And Munger once, I think Munger gave Ed Thorpe's book, Man for All Markets, to Monish at one point, and he said to Monish, you'll notice it's actually a love story. And it's not really a love story, but there is an element in there of Ed's love for his wife of more than 50 years who passed away, and now he's remarried. But I think of Ed as somebody who never underestimated the importance of relationships. And so when you're thinking about what you want to clone from the greatest investors or the richest, most successful people in the world, you don't want to clone the wrong thing, right? So you don't want to assume that enormous amounts of money are going to make you happy, because then finally you'll be independent and autonomous and can do everything you want and don't have to fly on commercial planes and stuff. Yeah, that stuff's true. But what I think is much more important is the relationships. It's who you're hanging out with. And Munger said this great thing where he was talking about Sumner Redstone, right? Who I've never met, and he passed away now. But Munger said that he went to Harvard Law School, I think, with Sumner Redstone, and he said, he was a tough tomato, and he ended up richer than I was. So some people would say he's more successful, but he said, when I think of Sumner Redstone, all my life he's an example of what I didn't want to be. And he said even his wives and kids hated him. And I have no idea if that's true. But when I asked Munger what we could learn from him and Warren about how to have a happy life, he immediately started talking about relationships. He was talking about the people in their lives, the people they'd partnered with, how they had so many honorable, decent people in his life. And he said, look, I've been a good partner to Warren, and he's been a marvelous partner to me. And so his entire success is built not just on his intellectual brilliance, but actually on his partnership with Warren. So I think that gives you a clue. And so when you're thinking of the desirable destination that you're working towards in your life, and you're thinking, okay, I want to look back at the end of my life and think, yeah, I had a happy and rich and truly abundant life, not just a financially abundant life, but a truly abundant life. What does that consist of for you? And I'm pretty sure that an enormous part of that is actually about relationships. And so then you have to really ask yourself, what are the inputs in order for me to get good relationships? Well, I have to behave better. I have to show up for my friends. I have to try to be more decent. I have to invest time in those relationships. And there have certainly been times in my life where I got off track, and I was so busy working that I didn't invest much time at all or much energy in my relationships. It felt like they were kind of a distraction. And maybe it was necessary at the time, but I look back and I'm sort of trying to make up for lost time, because I think it made for a poorer life, even though externally it probably felt more successful. But I don't think it made me happy, because you need people on the path with you who are sort of fellow travelers, and who can support you when you're miserable and down, and who enjoy your successes, and who you can celebrate their successes. So I think I don't know, that to me is an absolutely central aspect of a happy and truly abundant life: good relationships and peace of mind. That's the other thing. And so you got to figure out, how are you going to get peace of mind? And so you got to structure your investments in a way that gives you peace of mind, right? If you're I mean, in my interview with Bill Miller on the podcast a few months back, I was asking him, how do you deal with stress as a regular investor? deal with the tension. And he said, follow the advice. I think it was from J.P. Morgan himself, where he said, invest down to your sleeping point. You've got to invest in a way that allows you to sleep. And so having peace of mind in your investments, in your schedule, in your things like exercise and meditation, you have to really think about how they're going to help you build equanimity.
So you said the key word there, meditation. So whenever we are in the investing world and we're talking about meditation, we have to talk about Ray Dalio. One of the billionaires we had here on the show that have impressed me the most, for sure. And you recently spoke with Ray on episode 22 on the Richer, Wiser, Happier show. I would like to play this clip for you, William, and together with the audience, we can listen in here.
Let's go back, say, to that example from 1982, where I think there was a debt crisis where Mexico defaults on its debt. We have the worst debt crisis since the Great Depression. And you bet, I think, that the stock market and the economy would be battered by this. And instead, it actually strengthened. And it was sufficiently disastrous that you had to fire almost everyone at Bridgewater and ended up borrowing $4,000 from your father. When you think of that process in that case, how you went through this process of reflection on what went wrong, what happened, what flaws of yours this exposed, or what misperceptions of yours, and how you develop principles based on that, how would that be a good microcosm of what we should do when we screw up?
Oh, it was so good. It was such a painful experience. I think, and then I really learned pain plus reflection equals progress. That's one of the principles. I learned that every time I have an encounter, that it's like a puzzle, that if I can solve the puzzle, what should I do differently, or how should I deal with it? I would get a gem, and the gem would be a new principle and a learning that would improve my life. And so in that particular case, I learned to fear and deal well with the possibility of being wrong. It gave me a humility I needed to balance with my audacity. In other words, it made me think, how do I know I'm right? And then through that process, to try to find, out of curiosity, the smartest people I could who disagreed with me, and to study their reasoning. And it made me learn really how to diversify my bets. By diversifying my bets, I could radically reduce my risk without reducing my returns. And it let me also reflect on life. Like, I was at a juncture. I was broke. And it was, do I go get a job? Do I put on a jacket and tie and take the railroad into the city and work at Wall Street or something? Or do I not? And it was like I was sitting on one side of a jungle, and I could have the safe life by sitting on the one side of the jungle and not going into the jungle. But I knew that if I wanted to have a great life, I had to cross this jungle of all these threats in the jungle and survive. And then I sort of said, okay, what am I going to do? Am I going to live this safe life, and then it won't be as terrific, or am I going to go into the jungle? And how would I go into the jungle? And then I realized, I learned, okay, let me go into the jungle with people who would be on the mission with me and could see things I couldn't see. And we would protect each other as we went into this jungle. And I found out from that experience that I didn't want to get to the other side of the jungle, to the success, and sit on the success, because I found being in the jungle with these people, or being on the mission with those people, even through the ups and downs and the threats, was rewarding. That all came from reflections of that terrible mistake. We learn a lot from pain. Life, I think, it's almost a trick. That what happens is the second order consequences are so often the opposite of the first order consequences. In other words, the things that are really good for us don't feel good. And the things that are bad for us feel good. Okay, the tasty stuff is the stuff that is not probably good for you. The exercise that might be painful is the thing that you don't want to do, and you want to do the painful. Quite often, pain or that is the opposite. It's a trick. Can you do the things that are really good for you? And so those kinds of reflections, I think, were very powerful. And our experience really brought a lot of those. And from those lessons that I learned, that was the bottom. In other words, from that point, while there have been some ups and downs, it was almost totally up, almost all the way. There have been, of course, twists and turns and bumps and personal things, of course, terrible personal things that have happened. I lost a son. All of those things. But to reflect on reality, okay, what does it teach you about reality and whatever, and how do you approach that? All of those reflections, I've learned a lot from those reflections. And so it's that, at that instance, but, many since.
So this is just one of my favorite book of all times, Ray Dalio's book, Principles. Just to be clear, you were talking about his book, like the interactive book, Principles, and then there was the other book called Principles. I don't know if I don't.
Yeah,
think
the new one is
like
called
clear.
Your Personal Journal. I think it's Principles : your personal journal, and it's about how to develop your own principles.
Yes, wonderful. Just this clip here in itself is just, there's so many things to talk about. And of course, I would encourage everyone to actually go and listen to the entire episode. But he talks about pain plus reflection equals progress. And I mean, it's just so powerful. And I see the lack of that all the time. Not the pain part. We see pain everywhere, but the reflection part. I meet so many people where in investing, and whenever they make a really good investment, it's because of their skills, of course, because of the skills. And then if they lose money, it's bad luck. Like, oh my God, how could I foresee that XYZ happened? Like, so it's just bad luck. So it's so refreshing to hear Dalio talk about how he reflected and grew as a person from being wiped out in 1982. You specifically asked him about it. And that experience, and the first thing he said was, "Well, it was wonderful." Or I might not quote him correctly, but it wasn't like, "Oh, it was terrible." Like, no, of course it was terrible.
But it was so good. It was such a painful experience.
Yeah, and you might be like, "What? Really?" But yes, like that was a gift, and a gift that really changed his life onward. And I like to use this example where I wanted to explain the reason for it. So the brain is 2-3% of your body mass, but consumes 25% of your energy. And what that means is that your brain is wired to be lazy. It doesn't really want to work unless you force it to work. And that's also why I
feel like you're talking to me directly when you say you, Stig. I'm going to not be insulted, but yes, my brain is lazy.
Right. And it's a very interesting topic in itself. And if you want to learn more about that, Dan Kahneman's wonderful book, Thinking Fast and Slow, is definitely the source to go to. But most people choose not to reflect. A matter of fact, in 1925, Bertrand Russell, he had this wonderful quote in his book, The ABC of Relativity. Most people would die sooner than think. In fact, they do so. Unquote. I just kind of feel that was wonderful. And so we all know that if you're easy on your habits, life will be hard on you, and if you're hard on your habits, life will be easy on you. And this is not easy. We're not prone to think like that. I mean, I don't know how you feel, William, but whenever something hurts in my life, the first thing I want to do is to get away from it. I mean, I like to talk about it from an intellectual perspective. Oh, we should learn from it and we should reflect. But that's not the first thing that goes, at least through my mind. It's just, I just don't want it to hurt anymore. But I wanted to throw it over to you, William. What did you take away from an interview with Dalio? Let's start there and perhaps break it down.
Well, so much. I mean, I think start with that idea of him saying, when he looks back on this incredibly painful failure in 1982, where basically almost loses his career as an investor right at the start, and has to borrow $4,000 from his father, who was a jazz musician. I mean, wasn't like a rich guy. So it was a very humiliating and painful thing. And so Ray's response of saying, "Oh, it was so good. It was such a painful experience," is incredibly revealing, because what you're saying is you actually want to lean into your pain and not bury your own mistakes, your flaws, your failures from sight. So most of us want to hide from the things that went wrong or that feel wrong with us. And so there was a moment in that interview where I sort of I said to him, "Look, when I look at your new book, this thing, your personal journal, you talk about how to find the biggest obstacle to your success. And I look in my own life and I feel kind of ashamed to admit it, but I'm not systematic. I'm not process driven. I'm scattered." And I felt kind of flushed as I said this to him. And his response is like, no, that's great. And so he's not looking at my embarrassment about this flaw in my wiring and my personality or whatever it is. He's looking at it and saying, what a fantastic thing. You've identified this enormous thing that's an obstacle for you. And now that you've identified it and unearthed it and not been ashamed of it and buried it from view, you can actually deal with it. That's an immensely important idea. And that's something I've been thinking about really intensively in recent weeks, both before the interview, because I was preparing for it and thinking about what my biggest obstacles are in life, and since then. And one of the great lessons from Dalio is that you need this self-reflection. You need to start by looking at your own wiring, looking at your own values, looking at what's important to you, looking at your strengths and weaknesses in a really honest way. And so instead of being ashamed of it, look directly at it. So then you know what you're dealing with. You know the hand that you've been dealt. And so one of the things that Ray said to me in that interview is, look, I have a terrible rote memory. I couldn't remember things. I did badly at school when it was about rote memory. And so I started writing down principles because it helped me deal with my encounters with reality. And so one of the things that he did was develop this habit of writing down principles to, I think, in a way to guide him, because maybe he couldn't remember certain things. I don't know. It gave him a way to force him to reflect on what had gone wrong. Another thing that he did is he would see, for example, that he'd messed up in 1982 because he was too audacious, he was too bold, too arrogant. There was too much hubris, too much self-confidence. And so his workaround, once he knew that that was a flaw in his character, or a vulnerability rather than a flaw, his workaround was to surround himself with incredibly smart people who were not afraid to say that he was wrong. And in a way, you think about Buffett and Munger, and they've done the same thing, right? Buffett has said that Munger is the abominable no man, because Munger is smart enough and difficult enough and opinionated enough and feisty enough that he can say to Warren, no, I think you're totally wrong about that. And so part of the power of that relationship is that they've structured it so that you can be challenged by someone who's really, really smart. So when I'm kind of self-referential about this, and I think, okay, so what do I take away? How do I apply these lessons from Dalio? One of the things that I did is I went away and I did the Principles U character assessment test, personality assessment test that he developed with people like Adam Grant. And it's in the show notes for the episode with Dalio. And so you answer all of these questions, you start to get a sense of your wiring. And so I'm looking at this, and it's kind of shocking. I know you've done personality assessment tests before and are a big believer in them. When I do it, I come up, there are all of these archetypes that describe different personalities. So mine, not surprisingly, tends towards creativity, right? So excited by novelty, intuitive, curious, original thinker, all of that stuff. Fascinated by new ideas, comfortable in a chaotic and disorganized environment. And so on creativity, I'm like way up there. And then I think on the measurement for organization, I don't know. I think it was something like 2%. I mean, it was so embarrassingly low. Like the lack of systematization. It's just not part of my wiring, right? And similarly, there are other people, who have these archetypes of technician or implementer, which are the archetypes I'm least like. And so they're really organized. They really like structure, processes. They're methodical. They're orderly. I'm just not built that way. So if I'm prepared to look honestly at that wiring, not necessarily as a shameful flaw, but as just the reality. It's part of who I am. It's part of the gift. That's how my creator made me. And I'm sorry. And then I can start to say, okay, so what are the solutions? And so what Ray Dalio said in that episode is part of the solution is you work with people who make up for your own weaknesses, who are strong where you're weak. So that's been kind of a revelation to me. And this may sound really obvious to other people, but I can now see that my deficiencies in areas like efficiency, orderliness, systematization, practicality, it's not because I'm recalcitrant. It's not because I'm not trying hard. It's actually how I'm wired. And so I have to find people to partner with who are more systematic. So even, look, working with the Investors Podcast Network, the fact that you have this amazing team in the Philippines who have all of these structures and processes in place is incredibly helpful for me. That's a structure that gives me the space to do what I need to do creatively, where I'm thinking, who should I interview? What questions should I ask? How can I be present and intuitive about what they're really telling me and go in a different direction? So that all plays to my strengths. But then, for me to figure out the deadlines, I've never really figured out the deadline for my episodes. I don't know. I sort of have some sense of it, but it's really hard for me. Does any of that make sense, Stig?
Yeah, it makes a lot of sense, and I could, yeah, I could just say like here in the company that's true. Actually, we everyone here on the team have done a personality test. And we actually did that after read Ray Dalio's book, Principles. And he talked about how important it was. And, a lot of people don't like that because it's kind of felt they put into boxes and it's called personality types and it sort of like had a bad connotation. But you're actually doing it as a kindness because you want to treat people the best possible way. But in a large organization, it's hard to treat people well if you don't really know them. And of course, those closest to them would know them, but then there are some people another place in the organization that might not know how to speak with them the best possible way and what their strengths and weaknesses are. So everyone on the team here have been asked to take a personality test, and the only person who hasn't handed that in yet, that's you, William, which probably based on this conversation isn't too surprising. But I'm not trying to throw you under the bus when I'm saying this, but there's,
You're totally right.
when we're talking about like the structure and that part, and it is something that we are using. It's something we learned from Ray Dalio. Like everyone here on the team have read the book, and we applied a lot of his principles to our organization because it is an act of kindness. We want to be a kind company, and there are some people that want things a certain way, but it's easier to help people with what they need help with if they tell you. So it comes from a good place.
Well, it's also funny when I looked at the scores that I had for things like doing things my own way, breaking rules, stuff like that, being independent, being a conceptual thinker. I was like 98%, 99%. I mean, like sort of the degree to which I want autonomy is kind of extraordinary. Like the thing about not wanting guidance, I think I was 99%. And so that totally makes sense with the way that I went about my book, for example, where I just hold off for 5 years. I missed my deadline by 2 years. And I just was obsessed with trying to make it as good as I possibly could. So if it failed, it wasn't because I hadn't put heart or soul into it. I was going to put everything into it. It was all about quality. And I couldn't really explain why I did it that way. And then when I look at at my personality assessment, I can see how much I dislike rules and routines, how rebellious, how independent I am, how little I want guidance, but also how obsessed with quality I am. It sort of makes sense. And so none of this is either good or bad. It just is. And so I don't want to look at my being scattered or unstructured as a sort of shameful weakness, even though I kind of am ashamed of it and I regard it as a weakness, and it makes me feel vulnerable to admit it to you and the world. I need to actually look at it in the same way that Dalio looked at his flaws and weaknesses and say, okay, this is the hand I was dealt. How do I structure my life so that I'm playing the right games for me? I'm playing games that I can win. And so when I look, for example, at Guy Spear, I can see he's got this extraordinary woman, Chantal, who used to run a prison for war criminals, and then was basically sort of semi-retired, and then came in and has sort of organized Guy's life. And that is such an amazing thing, to have a hugely organized person come in and organize someone like Guy, who says, look, I have ADHD. I'm all over the place. It's easy for me to. I mean, he said to her at this, when he was first interviewing her, he said, "Look, I can leave the door of our office open in Zurich because I just forgot, and then I'll go to the airport and maybe I've forgotten my ticket or my passport. How would you deal with that?" And she's like, "Oh, that's fine. I got one of those at home." Like she's used to dealing with very brilliant people who don't have that sense of organization. And when I mentioned this, that I'd done the test to Bill Miller the other day, he's like, "Oh man, I bet I would do really badly on the organization stuff." And so Bill has got really lucky, I suspect, that he's structured his life so he has this incredible assistant, Darlene, who's been keeping him on track for the last 25 years or so that he's free to think. And so I think part of what's a frustration to me is that I think, as someone who's been writing books and doing podcasts and writing articles and stuff over the last decade or so, and ghostwriting books, I haven't really had a formal structure that I used to have when, say, I edited the Asian edition of Time magazine or the European, Middle East, and African edition of Time. So because there were people who were very, very organized and systematic, I was free to do the stuff that I was better suited to. And I think part of the realization that I've had personally is that I've sort of set myself up in this independent way where I don't necessarily have the infrastructure that I would have if I were working for another company. So I've somehow got to set that up and bear the cost for it myself. And so things like, I do some public speaking, and so I have a speakers agency that represents me, and they take a big slug of my speaking fees. And I'm like, wow, couldn't I do it myself? And I'm like, no, like, to be able to hand that off to someone so I don't have to actually create an invoice or figure out, like, I need to just accept the fact that the cards I've been dealt, when it comes to organization and structure, are the worst possible cards. And the cards that I've been dealt when it comes to thinking of new ideas or exploring concepts are weirdly high. And then there are idiosyncrasies. Like, one of the things that I'm sort of embarrassed about when I look at my assessment is it's really clear to me that I care what people think of me to a really high degree. I really care about being liked and respected. And so I can write as much as I want about Buffett's idea of the inner scorecard, living by an inner scorecard and only judging yourself by your standards. But the reality is, I really care what people think of me. And I can deny that and pretend to be something that I'm not. But I'm also in this peculiar position that now I know from this assessment that I care what people think of me, but not enough that I'm going to do what they say. I'm still going to do it my way and break the rules. And then I'm in this tortured position that I still want them to love me. And so being aware of your own flaws and foibles and idiosyncrasies, I think, is a hugely valuable thing. And so I'm not trying to be self-referential here. I'm actually trying to sort of say, I think our listeners would do really well to study what Ray said in that episode, but also really to go through the process of doing that personality test, go through that book, your personal journal, and really try to figure out, like, what do you care about? What are your values? What's a priority for you? And then you look back and you're like, well, how could I possibly have taken that job with those people? Like, why would I ever have thought that would work? Of course it wouldn't work. Whereas I look at my partnership with you, Stig, and the Investor Podcast Network, and I'm like, this actually is kind of a great partnership with me. It's like people I like, who are honorable, who are trying to teach stuff, share valuable information, interested in concepts. I have a lot of independence. Whenever I've asked you for advice on stuff, you sort of say, well, yeah, here's my view, but just do it, trust your own instincts. So you're giving me tremendous support and autonomy at the same time. And so one of the things that Ray said to me in that interview is life is really all about understanding your own personality and preferences and talents, and then picking, as he put it, suitable paths. I had great trouble pronouncing paths because to me it's paths. But
I remember.
but that's a really important insight, and like many of the great truths in life, it's actually a really banal and platitudinous insight. It's not that profound, but as Munger would say about investing, it's simple, not easy. And so when you come across a truth like that, you need to take it really seriously, I think, if it resonates with you. And so you need to say, okay, let me figure out who I am, what I'm like, how I'm wired, what I care about, what my priorities are, what a truly abundant life means for me. And then let me try to pick a profession, structure my day, structure my activities as much as I can to play to those strengths. Because if I'm playing somebody else's game that really doesn't suit me, I'm going to be absolutely miserable.
Yeah, so many things to unpack there, William. And it's so true. Like you can't. Let me give you an example. I was speaking with a guy the other day, and we talked about how much nonfiction a person should read, and I told guy that sometimes I feel. I'm not saying guilty is the right word here, but there's some things I want to be smarter about, including investing. And, there's an opportunity cost. I only have 24 hours a day like everyone else. So if I sit reading one of the classics, I'm not reading nonfiction, or, I'm not reading about investing or whatnot. And he talked about how he went through a phase of wanting to clone Buffett. And I think he also mentioned this in one of your books, William, where he was so relieved from meeting Buffett that, he's just playing such a different game than I'm playing. So I shouldn't be stressed about not being Warren Buffett because I'm Guy. So, I should be the best version of myself and be very, very aware of that. And it's just so profound to have that type of insight. And I could just, let me give you an example. Like, whenever we started working together, William, that was the most pleasant way of starting a partnership. The only other time I've done something similar been whenever I started working with Preston. I would imagine that we probably wrote a contract because it would sound weird if we didn't. I don't really remember, but probably also makes me sound a bit disorganized. But I remember you're like, this is the type of relationship I have with this person, and it's like, I trust you, you trust me. I'm gonna say yes to whatever you want to offer me, and offered XYZ, and you're like, sure, true to your word. Like, you're like, that's fine. And then you sent me, like, I sent you the annual report, and you said like, oh, if you think it should be paid more or less, that's also fine. We can always talk about it, but I rely on your better judgment. And I sent you like, yeah, we had a great 2022. I think we had like $2.2 million in free cash flow. And then I was saying, but we're also running a deficit right now. And for the foreseeable future, advertising being a boom bust cycle, I'm paying to go to work. And it's not like $10. It's like serious money I'm paying to go to work. So I'm taking money from my own account and putting into TIP. And that's perfectly fine. That's the nature of how this type of business is. And so, and you're like, okay. Like, and how wonderful is that to have that type of relationship? So
we also did this nutty thing when we were first structuring our contract. I hope I'm not speaking out of school by saying this, where you were saying, well, so we'll see how many downloads you get in the first month, because that's when you get most of the downloads for an episode, and then you'll get paid based on that. And I was like, nah, we should build in deferred gratification. So let's see how it does after a year. And so I basically structured it so that I wouldn't get paid a penny for a year.
Yeah.
Over a year.
Crazy.
That's kind of nuts.
Yeah.
But it's sort of, but it built in a principle that I think is really valuable, which is the deferral of gratification, thinking more long term. And so I don't know, there was something very, very characteristic of both of us in the way that we handled these negotiations, that it was an act of personal trust, and it was long term. And you were transparent. So when I asked you whether I should be getting paid more money recently, you were totally transparent about the situation, and I was like, okay, great. And I don't know. I think that requires you to be partnering with people who are honorable and decent. And so this gets back to something that Nick Sleep said in my book, where Nick and Kay Sakaria, who goes by the name Zach, had this extraordinary partnership that Nick said, look, it was built on kindness. And he said that originally they were going to structure it so that they would be 50-50 shareholders in their hedge fund business. And that was what Nick wanted to do. Even though in many ways he was kind of the alpha dog and was on top of the world and had been in the investment business successfully for years, managing money, whereas Zach was being tortured working at Deutsche Bank in an institutional sales job that he detested. And so in some ways, Nick could easily have demanded a better deal. And he's like, no, it'll be 50-50. And then Zach says, no, I want you to have 51% and me to have 49%, so that if we ever disagree about anything, you'll make the final decision. And then Nick said, when somebody hands you a loaded revolver like that and says, here, shoot me if you want, how can you possibly take advantage of them? And so because they were both right in their judgment of the other person's decency and kindness and sense of honor, it's really worked out. And I don't know, I think it's such an interesting model for how to do business. Buffett says the same thing about Munger, where he says in the introduction, in the foreword, I think it is, to Janet Lowe's biography of Munger, he says, I've never seen Charlie take advantage of anyone in 41 years. And I've seen him knowingly take the worst end of a deal with me and others. And he takes more of his share of the blame than he deserves. And I don't know. So if you go back to what we were saying before about the importance of relationships, and you think, okay, so a successful and happy and abundant life is going to have really good relationships with the people you work with your family, with your friends, that sort of thing. How do you get that? What Munger says is, look, we have a really simple system. He says, if you want to have a good partner, be a good partner. And so that's a really helpful distillation of wisdom from a 99-year-old polymathic genius. When Munger is saying, if you want to have a good partner, be a good partner. So then I have to think, well, what's Stig going through? What are the pressures on him of running a business? What are the pressures on the team in the Philippines if I can't remember my deadlines? And so I try try, despite my lack of efficiency or structure, at least to be kind and polite and respectful and thankful and that's sincere, right? I mean, I do feel respect and gratitude. And at the same time, I'm also aware of the fact that, I have this vulnerability and the lack of structure and the lack of systems. And it's not really my fault. Like, it just is kind of the way I was built. But I have to try to develop systems to overcome it.
That's so well said, William. And I want to say, speaking of this, and perhaps we can use this transition into talking about Charlie Munger, a person we referenced quite a few times here on this episode already, and of course throughout the story of of our podcast. So this question or this clip I'm going to play for you here is from the Danish Journal Q&A that he's doing together with Becky Quick, and it's sort of like going back and forth. So let's just play it, then perhaps we can talk about later what we took away from it. So here we go.
This one comes in from Matt, and he says, throughout your experience with Berkshire Hathaway, what are a few of the things that have surprised you most based upon some of your previous rational thoughts and ideas? Also, how have you used some of those surprises in your quest to become a better learning machine? These are all.
Well, I would say some of the things that surprised me the most was how much dies. The business world is very much like the physical world, where all the animals die in the course of improving all the species so they can live in niches and so forth. All the animals die, and eventually all the species die. That's the system. And when I was young, I didn't realize that that same system applied to what happens in capitalism to all the businesses. They're all on their way to dying is the answer, so that other things can replace them and live. And it causes some remarkable deaths. Imagine having Kodak die. It was one of the great trademarks of the world. There was nobody that didn't use film. They dominated film. They knew more about the chemistry of film than anybody else on earth. And of course, the whole damn business went to zero. And look at Xerox as once owned the world. It's just a pale shrink. It's just nothing compared to what it once was. So practically everything dies if you on a big enough time scale. When I was young enough, that was just as obvious then. I didn't see it for a while. Things that looked eternal and had been around for a long time, I thought wouldn't likely be that way when I was old. But a lot of them have disappeared. Practically everything dies in business. None of the eminence lasts forever. Think of all the great department stores. Think of how long they were the most important thing in their little community. They were way ahead of everybody in furnishing credit, convenience in all seasons, convenience back and forth, use same banks of elevators and so forth, multiple floors. It looked like they were eternal. And they're basically all dying or dead. And so that once I understood that better, I think it made me a better investor, I think.
I mean, the same can be said for managers. I've talked with Doug McMillon of Walmart, who carries around in his wallet, like on him, he carries around a list of the top retailers over the decades, and nobody's ever the same.
Yes, who are gone. Yes. Of course, retailers live in terror because you can die. Some guy gets a better way of doing it, and you just die, like those department stores did.
The ones that you invested in early on, you mean? Is it Baltimore?
Well, no, most of think of the department stores that are gone, just chain after chain after chain in big downtown. They're not weakened, they're gone, dead. And to have IBM have the huge position it once had in terms of utter dominance, and now it's just one of the also-rans. And it's still an admirable place. I'm sure they have a lot of talent left in IBM. It doesn't help you. You die even though you're talented and hardworking.
So I really like Charlie Munger's response here. You know, I mean, perhaps I could actually hop to another clip that he's also doing. We're gonna make sure to link to this. I want to say it's like 2 hours and 30 minutes or something like that. You can find it on YouTube for free and just watch it. But if I can just jump to another thing and then perhaps go back to what he talked about here in the clip. Becky asked Munger how many asset managers that was worth their fees. And he said 5% or less. And then so it sort of like goes back to what we talked about here in the clip, where capitalism is just so brutal. And great businesses come and go. He talked about Xerox and Intel and other companies. Well, Xerox is gone now, Intel's still here, but in a very different shape than they used to be. And it's hard not to think about, for an active investor like me, whether I should invest passively. Whenever you hear that, even Munger talks about how difficult things are now. And I'm sure many of the listeners have thought the same. The tenure in the S&P 500 is just getting shorter and shorter. Everything moves faster and faster. And you have more and more evidence about why passive investing is such a persuasive strategy. Also because you're fighting against your own instincts. So even if you were, quote unquote, as good as the market, you might still do some silly stuff because you cannot control your own emotions. And it's one of those things where you can have an intellectual discussion and say, I don't become emotional. And then something like COVID happens and the stock market is down 12% in a day. And you're like, this doesn't feel that well. And it's not the same whenever it's play money on fictitious portfolio. It's different if it's like, my kid's in this school and I need to, save up for college and I have hospital bills. Like it's just very different. So anyways, all of that being said, I'm still investing passively. Sorry. I have a few index funds too, but I am investing actively despite what Munger is talking about here. And I wanted to talk about that decision before I throw it over to William here a bit, because it's something I reflected on quite a few times here over the past quarter. I was looking at my brokerage account here the other day, and it turned out that I was marginally outperforming the market over the past 5 years. And so whenever I first saw it, it got me excited. I patted myself on the back for a few seconds, like, oh my God, you're that amazing. But then I thought to myself, Stig, you're the most ridiculous person in the world. Think about this marginal outperformance. You could have bought a passive index and saved thousands of hours not reading investing books and 10Qs and 10Ks. Like you do not appreciate your own time. Like that's ridiculous. And you could be down tomorrow. Why are you celebrating that? And so I thought a lot about that, and I had this discussion with some of my friends here the other day. So I have one friend who is financially independent after selling his company, and he now has this quote unquote problem, what to do with his time now, because he's mid 30s, retired. Like what do you do? Like you have all of this time all of a sudden. So he's very creative and sees investing as a way to preserve his purchasing power. Like he read a ton of investing books, so he definitely had the interest, but he would really like to spend as little time as possible actually investing and just live off that income if he can. He wanted to spend his time on something else, which I completely respect. And then, perhaps that approach resonates with quite a few of our listeners. And then you have the other approach, which might resonate with very few of our listeners. And I kind of felt that was interesting too. So I have another friend who is also an entrepreneur, quite well off, making close to 7 figures a year. And he's been asking me, like, what should I invest in? And I said that he should probably invest in a index fund, like track the world market. Done. Boom. And he said that he kind of felt uncomfortable doing that because he likes the hustle. Like he likes to work and just like, oh, I'm gonna get my expected 5% or whatever, however you want to make that multiple, but like it doesn't sit well with him because he was used to doing the hustle. And he said to me, and I don't know if this sounds ridiculous, but if he could still get 5% but just work hard for it, he would almost prefer it to not having to work for it and still get the same return. And so whenever he said that, I was laughing, but I was like, wait, Stig, you were doing the same thing. Like, you were getting a market return, but you're putting a bunch of time into it. And why are you doing it? It sounds so ridiculous. So I want to paint a bit more color around it, because in case there are some people out there who feel the same kind of conflicting emotions. So I love watching football. I absolutely love watching football. I do not get paid to watch football. I'm sitting in my couch watching my favorite team. I have a lot of fun.
This is soccer.
Yes, sorry.
Well,
yes, for the
not
American listeners. Yes,
football,
you call
yeah.
it, yes, soccer. Yes.
Yeah.
We call it football here. Yeah,
Real football.
real football. Yes. So, and I was like thinking, I'm sort of like trying to defend my own silliness by using the same analogy to for investing, because I love the process so much. I love reading 10Ks and 10Qs. Like it's as much fun for me as watching football or something else. Or hanging out with my friends. I just really like that. And so I know it's gonna sound ridiculous, but like if you told me like, yeah, you're not going to beat the market, and you would probably long term be absolutely right about it, I would probably still do it. Because why would I not do something, again, optimizing for happiness? Why would I not do something that really, really makes me happy? Even though
So it's a hobby that you're paying for in some sense. So if
sense.
you turn out to be really good and you make money, then it'll pay off. But if not, it's it's a bad analogy in some way to say it's like going to a casino but losing only a very small amount. Say you went to a casino and you said, okay, I'm going to gamble, but I'm not going to gamble more than $100. I'm going to get to eat in these really good restaurants at the Wynn Casino or whatever it is. I went to stay at the Wynn Casino once because I was working on a book project and staying in a beautiful room there. And so I didn't gamble at all, but I got to enjoy the food and I went to a great show and stuff like that. So I don't know, you could say it's a little bit like that. You're prepared to lose a little bit of money to support a hobby that you really enjoy, but there's upside here if you're right. If the danger is that we delude ourselves, right? So it's like people thinking they're good drivers.
Yes.
And so you have to, it all starts, I think, with self-honesty and self-awareness, to look at yourself and say, do I actually have any kind of competitive advantage? And when I said to Ed Thorpe, how can I tell if I have any competitive advantage? He said, well, if you're having to ask that, you don't really have a good answer, then you probably don't. And it's very deeply unsettling. And I have some competitive advantage potentially in that I know a lot of great investors. And so you could so look, like I talked to Bill Miller for a couple of hours the other day. I know how Bill Miller's invested. It would be easy for me to say, well, Bill really likes this stock, and this cryptocurrency, and I should do that. But that's really hard for me as well, because my situation is different than Bill's and my temperament is different than Bill's. So I'm not playing the same game. It would be hard for me to load up on Bitcoin. Whereas for him, he's perfectly happy with situations where there's an asymmetry where he could lose everything, but if he's right, he'll make enormous returns. For me, I'm less comfortable with that because of my personality. So I think a lot of this stuff really stems from self-awareness. And so one of the things that I've done in terms of sort of resolving this conflict between passive and active investing is because I'm kind of torn and I have the delusion that I can probably do well by investing with 2 or 3 really good active investors. There's a portion of my portfolio in, I think it's 3 different active funds that are all managed by honorable people who are very smart and very driven. And then I've owned forever 2 index funds. So I have and I'm not telling anyone they should do what I do. I'm just telling you how I'm trying to resolve my ambivalence about this question. So I own a Vanguard Total International Stock Fund and a Vanguard Total Stock Market Index Fund. And I think one of them, the US fund, has a 0.04 expense ratio, and the international one is 0.17%. So incredibly low expenses. And I pretty much split it 50-50 between those 2. And then I just keep adding to it. And it's in an IRA or a 401k or something, personal 401k. And so it's structured in a way that's tax efficient. It's somewhat diversified. I'm not, very low expenses. I keep adding to the pot. And I'm not making a big bet where I say, I'm sure the US is going to continue to do better than foreign stocks. I'm happy to take the hit in recent years of investing equally in foreign markets, which turned out to be better last year. And then I remembered this, I wrote about this briefly in the chapter that I wrote in my book on simplicity and Joel Greenblatt. And I talked about this interview that I had with Jack Bogle, the founder of Vanguard, which now manages $7-8-9 trillion, some outrageous sum. And so many years ago, I talked to the late Jack Bogle, maybe 20-something years ago. And one of the things that he said to me is, look, the ultimate in simplicity is to get a balanced index fund. And you just get one fund that has bonds and stocks in it. And so while I was writing that chapter, I actually did that for my wife's retirement account. And I said, okay, there's a series of Vanguard funds where you get, I think it's a mix of a US stock index fund and a foreign stock index fund and a US bond fund and a foreign bond fund. And so you've got 4 funds within this one thing, and it's really low expenses. And so I bought that for my wife, and I was like, that's a really elegant solution. And it seemed kind of stupid for a couple of years because bonds were paying nothing. But I've been too lazy to change anything with it. And now bonds are paying something, and also stocks did terribly. And so over the last year, I think it'll probably do fine over the long run. And so I just remembered this thing that Bogle had said to me, where he said, look, all of these star fund managers proved to be comets. And he said they light up the firmament for a moment in time. And he said, then they burn out and their ashes float gently down to earth. And Bogle was a great writer and speaker. He was very eloquent. And I just loved that line. And he said, look, this happens almost all the time. And so it's not all the time. It's not like nobody can beat the market. But you look at the people who beat the market. Look at someone like Joel Greenblatt, who had these extraordinary returns where he averaged 40% a year for 20 years. It's just outrageous. And I've spent a fair amount of time with Joel over the years and wrote about him at length in my book. And, he has a behavioral advantage, right? He's very calm. He's very even-tempered. He's super rational, very, very patient, very analytical. And he's also incredibly competitive. And that's another thing that I see with all of the greatest investors is they're super competitive. And so it's not just that they're intellectually strong, that they have some kind of intellectual advantage, though they do. I mean, you look at someone like Munger or Bill Miller or Ed Thorpe. I mean, these are supremely smart humans. There's also a temperamental advantage. They tend to be calm and rational, analytical, very disciplined. I'm not really built that way. I mean, when I look at that personality assessment, my way of making decisions is almost totally intuitive. I mean, I didn't make a super rational decision about whether to partner with you and the Investors Podcast Network. I did some research and some studies, and we talked at some length. But basically, I look at you and I'm like, I like Stig. He's a really nice guy, honorable person, and that's an intuitive judgment, and that serves me in certain ways in life. I don't think it necessarily serves me in investing. Because, one of the things I found the other day after I spent a couple of hours with Bill Miller is I really wanted to buy Bitcoin. And I was saying to this other friend of mine who's a well-known fund manager, part of the reason why I wanted to buy it is that I love Bill. And I feel like this sense of gratitude to him and appreciation for him. And in a way, there's this sort of this tribal sense of allegiance. And so there's this sort of emotional, irrational desire to buy something, almost as a way of declaring my psychological and emotional allegiance to him. That's a weird quirk in my character that probably allows me to interview people in a good way because I'm empathetic. I get into their minds. I understand how they view the world. There's a certain degree of intuition and rapport that's really good for an interviewer. But it's not very rational when it comes to picking stocks or cryptocurrencies.
No, you're probably right about that. And I thought a lot about it myself. I kind of So for example, investing with Manish, I felt that Manish was the right way of merging a person with good values, but also someone who could outperform the market. I'm very humble about my own skill set, and do not have any illusions that I can beat the market. And what happened was probably more luck than anything else. And so whenever I invested with him last year, and invested in his fund, I couldn't help but consider, what kind of bias do I have to do this? Is it because of some kind of tribal thing that you were talking about before? Now I can look back and say that the market was down, and then Manish's fund was up 35% over the last 3 quarters of 2022, because Manish is just super smart. But I think it's also important not to be prone to what Anidu calls resulting. Like, I think I could have been too hard on myself if things have gone bad, and I'd be like, oh my God, that's only because, there's some kind of, I don't know what you want to call that, but going back to the word tribal again, of like having invested with one of a person like Manish, is there something emotional there? I remember you talked on the episode with Annie Duke about how you invested in Alibaba after having a discussion with Charlie Munger at like a virtual bronze type thing, and there's something about that type of stamp of I'm not saying stamp of approval, because that was not the specific case, but like you're in the same tribe, so he invests in Alibaba, you invest in Alibaba. You have this insight perhaps that other people don't have, or they read it later on that aroma, whatever it is, but like you heard it from the horse's mouth first. I can understand what you mean.
I had Munger and Lou Simpson telling me how much they loved my book, and telling me that they'd both been investing in Alibaba. So I have 2 of the greatest investors telling me that I'm great. And here we are. We know from my personality assessment that I really crave respect and liking and admiration, right? So I'm very vulnerable to this. I look up tremendously to Munger as like one of the smartest, most brilliant guys around. And so here's Munger saying, your book's one of the best investing books ever written. And so I'm like, this is like amazing for me, right? And then Lou Simpson said something really nice about it as well. And Lou's one of the great investors of all time. And so this is like this banner day for me, right? Like I'm just like floating on air. And so how do I memorialize this day? Partly by buying Alibaba. That's an act of allegiance to these 2 great investors who just told me how wonderful I am, at least in my interpretation of it. I mean, Munger probably doesn't remember my name at this point, but for this brief moment, I felt this flush of importance. And so there's an irrationality in that purchase of Alibaba that's come back to haunt me. But at the same time, I think it's down about 55% since I bought it. But at the same time, I didn't put that much in it, so it doesn't really matter. And it wasn't that stupid an investment, because it's a long-term investment in China, which is very beaten up. Everybody hated it in a sector that everybody hated. And it had been bought by two of the greatest investors. And I knew that they had done a lot of work and understood it. And I knew that Munger is very close to Li Lu, who's an expert on China. And so there were rational reasons to do it. And if I was wrong, it wasn't really going to hurt me. And as a diversifier, it's not a bad thing for me to have a long-term bet on a centrally important company in China. And, so I'm down by half. It doesn't mean I can't send my kids to college or retire. It's okay. So I think you have to be aware of your own flaws and vulnerabilities and irrationalities and hedge against them in some way. So I was talking to a friend the other day about my mistake with Alibaba and then my desire to buy Bitcoin after my conversation with Bill. And my friend said, yeah, we had a rule at this investment firm where I used to work where there was a cooling off period for a week after you met with management of a company. And I thought that was really smart, right? Because you're very easily sold on stuff. You have all of these hypesters who are great salesmen who believe in the future of their company and they can sell you anything. And so to have a cooling off period is not a bad thing. And so for me to calm down, look back with a glow of affection on my meeting with Bill Miller, but not be so not be so grateful for the fact that he treats me nicely and that I need to be treated nicely and appreciated, that it skews my judgment. So part of what I'm doing is I'm hedging against my own fallibility and idiosyncrasy. And so I'm trying partly not to buy individual stocks. I only own 3 individual stocks, and one of them is Berkshire, which I regard kind of almost as a fund. And one of them is Seritage, which again I bought after hanging out with Monish. And so it's the same flaw in a way. It's like I fall in love with Monish, who's an old friend and someone I like and admire a great deal. And then I buy this stock because he'd bought 13% of the company at a time when it was hated. And what I was realizing in my conversation with Annie Duke is, as I talked about Monish and as I talked about Charlie, I start to smile. And I'm like, oh my God, I'm so vulnerable. Like I love these people. I really admire these outsiders who are rebels, free thinkers, going against the crowd. And so it's a tremendous vulnerability for me. And so it's smarter for me on the whole to try to outsource the investing decisions and also to try to index because and sort of systematize. But at the same time, given that I'm writing and talking so much about investing, I also think it's a pretty good thing for me to have some skin in the game and to understand in a very visceral sense the emotions and the irrationality that go with making mistakes or doing well. And even with something like Seritage, it was so cheap that it's actually done pretty well anyway. So it's sort of made up for, there was a margin of safety built in because it was so cheap. And so that's made up for my stupidity and irrationality.
Yeah, I can't help not to bring up the bats here, William. But later in this Q&A with Munger, he was asked about his Alibaba position, and he said that he kind of felt he was. I'm going to paraphrase this. This is not exactly what he said. People can watch it themselves. But he was saying that he was so fascinated about this story of the Chinese internet and the e-commerce rising in China that he forgot that Baba was just another damn retailer. So as someone who also bought Alibaba, perhaps for the same reasons as you, William, that did not make me feel good. And it was just screaming in me to sell after I heard that. But then one of the things that had been good to me was I spoke already with Guy on one of the first episodes we ever did here on the show, which is very nice of Guy to make himself available. And he talked about the 2-year rule. And about he wanted to, there could be exceptions, but generally the rule was not to sell anything the first 2 years after you made the position. And I made the position, in a year and 9 months ago or something like that. So I was like, no, that's not the two-year rule. 2-year rule, which has been good because you, as you said, you have to manage your own biases.
Yeah, and I have a 5-year rule. So I'm really trying to prevent myself from doing stupid stuff because I sort of have to live with my stupidity if I mess up. But maybe that's a bad idea. I don't know. I really don't know. But I think it, I mean, Annie Duke had a good discussion of this in our conversation. It's worth people going back to, because she was sort of making the point that you need to relitigate the situation, like go back and see, well, what's changed here. But I think there's something useful about having the 5-year rule because it makes you less willing to make bets going in. If you know you're going to have to live with it, you'll make fewer bets. And so, look, I'm living with my Berkshire Hathaway bet. And I think of it, I hope that I own it more or less indefinitely. I'm living with my bet on Guy. I've invested with him for, whatever it is, 22 years so far. And I've said to him, I regard it as a 40-year investment. And so we'll see. If I'm wrong, fair enough. But I think in a world where most people are very short term, if you can push yourself towards being long term and patient, that's a tremendous advantage. And so I think having a few simple rules in life is hard. Like when I just decide, for example, that I'm not going to eat in the morning, I won't eat before noon. That's pretty helpful. And then when I decided I wasn't going to eat any sugar this year, that was pretty helpful. So when I was in Zurich and Klosters and stuff, dinner, would come with dessert, and I'd be like, no, I'm not eating any sugar. And it was very simple. It like clarified things because there was a rule. And then I think I was at some dinner, I can't remember where it was, where there was I think I went to my sister-in-law's and she cooked a really nice meal and there was dessert, and I would have felt rude if I hadn't eaten it. And once that rule was broken, it was like the floodgates were open.
Yeah.
And so I think sometimes giving yourself a simple rule that you can't break is actually a really helpful thing.
Well said, William. Well, William, we're a bit long on time here, as we always are, but I really want to go to the last part here of our discussion today, where we talk about the best books we read the past quarter. Q1 is always a great quarter to read books, and at least where I live, it's dark and it's cold, windy. You don't want to go outside, so you can just curl up with a book or a 10Q or 10K, whatever cuts your fancy. And I just want to give an honorable mention to Principles, your guided journal by Ray Dalio. I did not put it on the list, the top 5 list, because it's not really an investment book, and I sort of like wanted to focus on that. So this is my curated, no particular order, of the best 5 books I read in business and investing over the past 5 years or the past quarter. So Competition Demystified by Bruce Greenwald, wonderful book. The Little Book of Valuation by Aswath Damodaran. Benjamin Graham and the Power of Growth Stocks by Fred Martin. Big Money, Think Small by Joel Tillingham. And The Joys of Compounding by Gautam Bate. All wonderful
Joel
books.
Tillinghast, right?
Yes. Sorry, what did I say?
Tillingham. Yeah, Joel Tillinghast.
Sorry. Yes. Wonderful book. Hey, so perhaps let's start with the Joys of Compounding here. This was a book that our co-host Clay Fink recommended to me, and he said to me, like, I feel I could do 4 episodes on this book alone. So I sort of like had to pick it up, and I received it in the mail, and I flipped to the back, and lo and behold, there's a gentleman called William Green who have this
I gather. Amazing.
Yeah. Who's that? So
and handsome.
Handsome. I'm pretty sure too. Yes.
Slim.
Slim. So it says here, Gautam is a marvelous role model because he's such a joyful and passionate student of worldly wisdom. In this book, he gives us a powerful reminder of how enriching it is to dedicate ourselves to the pursuit of continuous lifelong learning. So, with that, William, I want to throw it over to you and talk perhaps a bit about this wonderful book, The Joys of Compounding.
Oh, sure. I was thinking as you were going through your list, I'm lucky that I actually know all 5 of those authors. So, so I'm totally biased because of personal relationships or interviews that I've done with these people in the past. And so Gautam is someone, is a very nice guy, really nice, really thoughtful, someone who came from a kind of modest background and was applied for so many jobs in investing. And, he's been really open about how difficult it was for him to get hired and how persistent he was in launching himself as an investor. And he's kind of indomitable in the way that he persists and in the way that he's become a learning machine. And so he's someone who's just really systematically gone about teaching himself the principles of investing. And so there's something just very admirable about that as a role model, the sort of person who sets about synthesizing everything that he's learned from Buffett and Munger and Howard Marks and Kahneman and all of these great minds. And so I don't think it's not that it's a trailblazingly new book where he's gone and interviewed all of these people. It's that he's been incredibly committed about learning what all of these great minds have figured out and then synthesizing it. So you open the book, and I remember just at the very start, for example, it would have a line from Munger, the line where Munger said that the best thing a human being can do is to help another human being know more. And so it's full of things like that where he's just distilled and synthesized so much wisdom about everything from living by an inner scorecard to delaying gratification. So I think there's something really, really central to learn from Gautam about, I never quite know how to pronounce it, Gautam, so I'm sorry if I'm getting it wrong, but there's something really admirable about the way he set himself up to be a continuous learning machine. And then at the same time, he lives in this kind of humble way. He's not money obsessed. He set aside a certain amount of money. He's made a certain amount of money off his investing, and he's kind of happy with that. And so he lives modestly and is just sort of playing the game that he really loves playing. And so I kind of admire him because of those qualities. And then, the book is published by Columbia University Business Press, which picked up on the fact that he had written this self-published book. And Miles Thompson, who's this terrific editor there, who I've become friends with over the years, I think saw that there was something really good here and came and did a new edition of it that was sort of new, improved, polished. And so I also think it reflects the fact that Miles Thompson is kind of a terrific editor, that he put out this great book.
So definitely highly recommended, The Joys of Compounding. Not just by our friend William Green, forward by Guy Spear. Fantastic book. I wanted to highlight Joel Tillingham's book, Big Money, Think Small. So there were so many key takeaways, and if you are interested in learning a bit more, it's going to be a very quick run through here. William, you had him on your podcast, Richer, Wiser, Happier podcast, not too long ago. Super smart person, and if possible, as kind and thoughtful as he is smart. Like it was really a wonderful episode you did with him. I want to say that one of the favorite points that I had from Joel's book was how he reminded us that advertising spending can be an investment more than an expense. And even management themselves can't always distinguish between economic goodwill or just cash out the door. Until future sales on the contract, GAAP rules tells us that it's all expense as a cost through the income statement. And then of course you can ask like a a company or brand like Louis Vuitton, whether they feel that advertising is money up the door. But that is just how it's being treated. And so I kind of felt it would be an interesting segue to talk about the richest man in the world. I don't know if people listening to this, if they think of who they think the richest person is, and I would imagine a lot of people would say Elon Musk, perhaps, or Jeff Bezos. They're, by the way, 2 and 3 respectively on that list. It's a gentleman named Bertrand Arnault. His net worth is more than $200 billion. He's founder, chairman, and chief executive officer of LVMH. So he owns, that's the company that owns Louis Vuitton, Dom Pignon, Tiffany & Company, and many other very well-known brands. And so Arnault famously referred this conversation he had with Steve Jobs, now the late Steve Jobs, and asked him if he thought, he being Steve Jobs, people would still use iPhones 30 years from now. And Jobs said that he didn't know. And whenever Jobs then turned the tables on that question, Arnault said that, Steve, I think people will still be drinking Dom Pignon in 30 years. We are selling part of history. And so I don't know if that was actually a real conversation. That's how the story goes, and that's what Arnault has been quoted to say. And I think it's important to understand that a brand is like any other asset. They produce income, but they both require initial investment and continuous spending to sustain their established status. And you can even compare it to PPE in that regard. And I also want to highlight, kind of like use that as a segue to highlight Bruce Greenwald's book, Competition Demystified. It's just a wonderful, wonderful book. And he talks about how you have to distinguish between brand value, which is the premium customers will pay for a product from a particular brand, could be Louis Vuitton, for example, and then economic value, which is the additional return on investment that that brand helped generate. For example, Coca-Cola is a value brand, and here we're talking about economic value in a different way than Louis Vuitton. No one will pay thousands of dollars to be identified as a Coca-Cola drinker. But it's a valuable brand because it's very habit forming. Let me just give you one simple example that he writes about in this book. When you go out for Mexican food, you might order Mexican beer, but you don't order Mexican cola. And I could also mention that we like to eat different types of meals, but we often drink the same, whether it's your Starbucks coffee, whatever it is. So that was very brief. I went through those 2 books. Perhaps another time, when you have a bit more time, we can go more into depth with the books. They're absolutely amazing. Let me throw it over to you here, William.
Well, I tell you one thing that I learned from Joel Tillinghast's book is his tremendous focus on not doing dumb stuff. So he's focused on brands. He's focused on companies that are durable. So I think he's made 1,000 times his money on Monster Beverage, which I talked to him about in the episode. So he's made money off enduring brands. But although Monster Beverage is probably about as far from Dom Perignon as
right.
as could be imagined, but yeah, a durable brand that he bought cheap many years ago and has held on to. But for me, the most powerful lesson I've learned from Joel Tillinghast, I think, is avoiding what Munger calls standard stupidities. And so when I first went to interview Joel Tillinghast at Fidelity's office in Boston several years back, I was trying to figure out, like, how is this guy beaten the market by such an enormous margin over so many years? I mean, he's Peter Lynch said he's basically one of the greatest investors of all time. He's been extraordinarily successful. And the more that I talked to Joel about how he's done it, the more clear it became that it's partly by avoiding so many dumb things that blow up so many regular investors and professional investors. And so one thing he said to me is, look, don't pay too much for any stock. Don't go for businesses that are prone to obsolescence and destruction. Don't invest with crooks and idiots. Don't invest in things you don't understand. So just think about that list of of standard stupidities, as Munger would call them, that get us in trouble again and again, right? Think of the number of people who overpaid for hot tech stocks in the last year, where they got just eviscerated because they paid 10, 20, 30, 50, 100 times sales. And so there's this irrationality that creeps in, especially during bull markets, where you see other people making money and it becomes kind of intoxicating, and you lose your connection to reality, to the underlying reality of the economic reality of the business. So even with something like LVMH, I had a long discussion with Guy Spear about this when I was in Klosters, and Guy's fascinated by LVMH and by the luxury brand business. And he's like, look, it's an incredible business, and there are certain benefits that you get when you have their scale, because you can kind of bully your way into the best stores, and and you get your second and third brands in there because you got such powerful brands. So there are definite advantages. But then he said, but I just can't pay that much for it. It's just too expensive. And so that's one of the things that's keeping Guy tethered to reality. It's just his sense of the valuations. And then this question of what businesses are prone to obsolescence and destruction. So you think of Munger, his revelation during the Daily Journal annual meeting, where he's just saying everything dies, everything is impermanent. And so it's really important just to go into investing and life with a sense that things are impermanent. And so, a company that seems very powerful today may not be 5 years, 10 years from now. And likewise, the conditions that exist at the moment economically or in the market are not likely to prevail for several years, right? One of the things that Howard Marks talks about is that there's this kind of pendulum effect where the market goes from fear to greed, or complacency to terror, or overpriced to underpriced. And you see the same thing with the credit cycle. It goes from they'll lend money for anything, and then suddenly they'll lend money for nothing. And so once you understand that we live in a world where everything is prone to change, everything is prone to die, and there's creative destruction, you have to set yourself up to survive an uncertain future. And this is one of the great lessons from Howard Marks, I think, and from Joel Tillinghast and Joe Greenblatt, Charlie Munger, Buffett, all of these great investors. You need to build in some margin of safety when you invest, because the future is so unstable. It's so uncertain. Things that are powerful and dominant now will not be in 5-10 years. I mean, we have no idea whether Tesla is going to live up to its promise. And so should you pay a very rich multiple for Tesla? I don't know. I couldn't bring myself to do it, but maybe I'm totally wrong. But at least you have to be aware of the danger that things that are ascendant now are likely not to be in future, and the things that are undervalued now are likely to have their day in the sun one day. So, and then I think Tillinghast's idea of don't invest with crooks and idiots, that again gets back to the thing we were talking about right at the start of the conversation, which is it goes back to Buffett's point that you can't do a good deal with a bad person. You want to partner with good people. And then Tillinghast's idea that you don't invest in things you don't understand gets back to something that John Templeton told me 20-something years ago, where he said, stay away from your own ignorance. And so investing is really difficult, as we've discussed in this conversation. It's really hard to beat the market, but at least you can give yourself an advantage by avoiding standard stupidities. So don't overpay. Don't assume that the future will look like the past. Diversify. Don't invest in things you don't understand. Like, be a learning machine where you're constantly building your circle of competence, but at the same time trying not to delude yourself into thinking that you're better than you are and know more than you actually do.
Well, to quote Charlie Munger, it's simple but not easy.
That's for sure.
William,
and I saw Bruce Greenwald the other day, Stig, and Bruce said to me that he was talking about exactly that. He was saying, that one of the things people feel when they listen to Buffett speak is he makes it sound so simple, and he's like, boy, is this not simple? This is not easy. It's really hard. And I think that's a worthy message for people to be aware of, that yeah, you can beat the market, yeah, you can do incredibly well, but you got to be good. You got to really take it seriously to be a kind of mental athlete, to win at this game. You need to be really good, and you need to be driven and devote the time to it.
And just on that note, competition demystified. This book is a few years old, so I think it's from 2005 ish. Bruce goes through wonderful examples on different industries, and it's so interesting to read about these companies that today are not performing well. And the premise, I also want to say in Greenwald's defense, because I don't want to make it sound like he's making any kind of stock recommendations at all. That's not the point of his book. He's talking about different industries, barrier of entry, using that as your framework of picking stocks. And it's just interesting to hear someone as smart as Bruce Greenwald talking about different industries 18 years ago, and then think about how those industries look today. And it's, whenever you read the book, it can seem like the barriers of entry is just impossible to penetrate. Not that it's Bruce's premise, but it can seem like that way whenever it's being explained. And then you read it and you're like, but that company doesn't exist anymore. Wasn't it supposed to be close to impossible? And yeah, like you said before, William, that goes back to what Munger said, that one of the things that he learned throughout his life is just how the only thing constant is change.
Yeah, and Bruce is profoundly brilliant. Bruce is someone I was trying to seduce him into coming onto my podcast later in the year, and I think he's going to. And he doesn't talk often in public, so it'd be great to talk to him. He's a brilliant mind. Wonderful.
William, we have passed the 2-hour mark here for this conversation. Again, it's thank you for making time to speak with me here today, William. It's always a lot of fun. Any concluding remarks? Anything you kind of feel we should touch on before we end the episode?
I guess you gave your 5 recommendations for books. I would add one recommendation that's not a book, but which is something I talked to Fred Martin about, which is I think people should watch this movie Free Solo, this documentary that I talked about at length with Fred Martin, which it's about someone trying to climb El Capitan, which is basically 3,000 feet straight of granite. And this guy decides to do it without ropes, without any equipment. He's just going to do it free solo. And Fred's point is that it's a brilliant example of risk mitigation, what this guy does. And I think it's all about survival. It's all about risk. It's all about trying to take considered risk, intelligent risk, so that you'll actually survive. And I would just really encourage people to watch it. I think it's on Disney Plus or Hulu or both, and you can also get it on Amazon Prime. And so for those of us who have short attention spans and find it difficult to sit and read long books, you can treat yourself to watching Free Solo and can listen to my discussion with Fred about it, who's very, very thoughtful about what it actually means, what you can learn about how to survive as an investor based on studying this great free solo climber, Alex Honnold.
Wonderful. We'll definitely make sure to link to that in the show notes. William, on that note, let's end the episode here. It was a lot of fun chatting with you, as always, William. So thank you for making yourself available.
Thank you. It's always a delight, Stig. I really appreciate it.
Reality is reality. So how does it work? And how do you interact with it to get what you want? I think you have to be careful about that and diversify well and beware of fads. And so we're now seeing a type of conflict that we never saw before.